It's a very lovely morning from here in Delhi and hope each one of you are absolutely fine. So in this particular session, we are studying Accounting Standard AS-1, which happens to be a very simple accounting standard. Each one of you are very well familiar with this standard. You have studied it so many times, so I did not require to what we could tell you what exactly we are going to study in this. Correct? As you know, AS-1 actually deals with disclosure aspect, no doubt about that. And accounting is an area where there are lots of alternatives available. Suppose there are two entities. One entity has gone for what we call a straight line method of depreciation, while the other entity has adopted written down value method. They have the prerogative, they have the choice. Correct? Now let us say there is deviation in their final results. Presuming that profits of a particular entity is 5 lakh and the profits of the other entity are 10 lakh. Because of differences in the methodologies or in the accounting policies with respect to what we call depreciation, let us say there is a difference in their net profits. But we won't be able to assess and know actually what exactly is the cause of the deviation unless and until we have this fact before us. So that is the reason that why this particular standard, first of all, has been framed. And that is the reason why this particular standard forces the enterprise to come out with the disclosures of their accounting policies, which they have adopted while preparing their financial statement. And at the same time, as we know, in accounts, we take so often many assumptions. So in fact, if a particular entity has taken a particular assumption, they should actually disclose it by way of note, so that whosoever is interested in the financials of that particular entity may get a better idea regarding the what we call their profitability, or in assessing the profitability or other decisions, or basing other decisions. So that is the reason significance of this particular standard is quite vital. So without dwelling much deep, now we come directly to the point. I have already told you it's a very simple standard. So let's go and directly what we could come to the point. So accounting standard AS-1, as I said a moment ago, so this is the standard which we are going to start today, accounting standard AS-1, correct? Most of you are very well familiar with this standard, no doubt about that, but still, as our habit is, we are going to take a deep insight. We are not going to take it lightly. We take everything very, very deeply, and we are going to continue with the same approach, correct? So, accounting standard AS-1. So, please pull out your pen, pencil, registers, whatsoever, because you have to write along with me. And let's start now. As I told you, accounting standard deals with the disclosure of significant accounting policies and at the same time fundamental accounting assumptions which an entity actually has taken while preparing its financials. So we write, this is the first sentence which we are going to put up here, correct? Let me actually first adjust the sheets and other things. Sometimes it becomes otherwise very difficult. So let's start, correct? I'm writing in point wise. It is up to you. So standard deals with, as I told a moment ago, deals with disclosure of what? Disclosure of significant accounting policies. Significant accounting policies. Significant accounting policies and fundamental assumptions and fundamental accounting assumptions which an entity which an entity uses or adopts this is A, adopts in preparation of its financials, in preparation of its financial statements. So whatever assumptions and the significant policies which you have adopted, correct, you need to actually disclose them. That is the theme of this particular standard, as each one of you are very well aware of it, correct. Now we move over to the other part. Point number 2, every entity should, no doubt about that, disclose all the significant accounting policies as far as possible at one place. This is the next point. Every entity should disclose all significant accounting policies by way of notes at one place only, at one place. So all the significant policies which you have adopted should be disclosed at one particular place. You should not scatter them, correct? Now, what exactly then accounting policies are? We need to have an idea. Accounting policy means, suppose we know that in accounts there are several accounting policies with respect to depreciation, with respect to inventories. So when I am going to use a particular accounting policy for a particular purpose, for a specific purpose, that is nothing but accounting policy. This is my accounting policy. Your accounting policy might be different. So the accounting policy simply means when you use a particular method for a particular thing. It is as simple as that. Put it in simple words, correct? So anyway, still I am going to write accounting policies. Accounting policies are specific, means particular, specific accounting principles, particular accounting principles and methods adopted by an entity in preparation of its financials, in preparation of its financials. When I write financials, it means financial statements, correct? Just a moment ago, I also told you there are several accounting policies, correct, which are available for a particular item, correct, or a particular transaction. So management need to be very careful and exercise a lot of judgment that which accounting policy they should use or continue off with, correct? And of course, when we use a particular accounting policy, we need to take care of what we call any associated provisions of law also, correct? It should not violate that. At the point is this. So in the next sentence, I write exactly this. There are There are several accounting policies. There are several accounting policies, no doubt. There are several accounting policies available correct, and you know about all those for measurement of an item or transaction or transaction. Thus, management should exercise lot of caution, and just a moment ago I also told you this. Thus, management must exercise caution in selecting suitable accounting policy. Which accounting policy will be best suited to you? Selecting suitable accounting policy. Management should consider nature of business, legal requirements, accounting standards, etc. in selection of accounting policy. Selection of accounting policies. Which policy will be best for us? We have to exercise caution. We have to take into account, as I said, our nature of business and all the associated legal framework and of course the provisions of accounting standard. Correct? Just a moment ago, I also told you that there are several accounting policies, and I will give you the examples. Examples of accounting policies. Examples of accounting policies. Several, so many. For example, we know that with respect to depreciation, there are several accounting policies, several methods. With respect to depreciation, a straight line method you can use. So if you are adopting a straight line method for a particular transaction, correct, or particular item, so it is a case of what we call your accounting policy. Similarly, written down value method or diminishing value method, sum of digits method, sum of digits method, sum of digits method. Similarly, if you allow me to give you more example, you might be feeling, sir, we know already, but I simply can't help it. When we take a particular topic, we always presume I should not say that we presume. In fact, we always take the things and start the things right from the scratches. With respect to inventory, there are several. You can use FIFO method, you can use weighted average method, you can use HIFO method, highest in first out, you can use NIFO method, next in first out. Have you heard about it? Be honest. Anyway, then similarly, suppose I want to amortize. You know word amortization generally. Just wait. Is used in the context of intangible. So amortization of intangibles. Amortization of intangibles. So an intangible asset is amortized, depreciated it means amortized, and for amortization you can go for straight line method, you can go for sales method, etc., or any such method which best represents the pattern of use. That is the point. Correct? Similarly, valuation of financial statement, again valuation of fixed asset, valuation of PPE, property, plant and equipment. You have the choice to use historical method, historical cost method, historical cost. You have the choice of revaluation method. How many examples I have given? 1, 2, 3, 4. Okay, I will give you one more and then I will stop this. Construction method. Construction contract, Construction contract revenue. In measuring any revenue from construction contract, we have the choice. We can go for completed services method. Or we can use proportionate completion method. So there are several alternatives available to an enterprise. That is the problem. So in the absence of any relevant notes, we may not get a fair idea regarding the deviations or the differences in the profits. That's the reason significance of this standard is quite what we call high. Now, which was the point? I was writing 7th, now 8th. Accounting policy disclosure. I have already told you regarding that. Accounting policy disclosure. The disclosure of accounting policy, as I told you, will help in understanding properly the financial statement. Accounting policy disclosure helps the users in a better understanding of financial statements, better understanding of financial statements. FS means financial statements, correct? B, to have a meaningful assessment. To have a meaningful assessment. in the absence of relevant notes and notes, we may not be able to properly assess, as I said, the financials of a particular entity. Just a moment ago, I told you there are several alternatives available with respect to accounting policy, and management should exercise a lot of caution. Correct? We'll continuing. In fact, we are coming back to that topic, consideration for selection of accounting policy. Considerations for selection of, consideration for selection of accounting policies. Actually, consideration for selection of accounting policy. Basically, these consideration can be divided into two parts. Can be divided, where is the scale actually? Yes, scale is lying here. Okay, let me write. There is no point in using a scale. One is A, primary consideration. Primary means main. Primary consideration. As far as primary consideration is concerned, in selection of an accounting policy, your basic, what we call motive is that your financial should give a true and fair view. That should be the primary, foremost, prominent, significant, what we call consideration. Primary consideration implies that policies selected should be such as to provide true and fair view of the operations. That should be your primary consideration. Besides this, there are other considerations also, and these are known as what we call secondary or major considerations. Secondary considerations. Under these considerations, as I already told you, you have already done this chapter so many times, so you must have heard about. Secondary consideration doesn't mean that they are secondary, not important. That doesn't mean that. It means they are major consideration, but your first consideration should be this one. Major. These are also known as major consideration. Under secondary consideration, we will see actually there are three types. One is known as prudence. Prudence. What we mean by prudence? Prudence means, technically prudence in Hindi means soch ke, samajh ke. Think before you leap, it means. But here prudence means be cautious or apply wisdom. Think, as I said, before you leap upon a particular what we call conclusion. So prudence simply means caution, it simply means wisdom, or intelligence, you can also call it that way. The entity should apply what we call prudence in selection of an accounting policy. For example, if we are anticipating a loss, then prudence says that we need to actually provide for this loss, and we have to reflect that provision in our financials. That is the reason why all anticipated losses are reflected in the financial statements. So prudence. Prudence simply means caution or wisdom or intelligence. Intelligence, full stop. Entity must apply prudence in selection of accounting policies. Correct? It is on account of prudence. It is on account of prudence It is on account of prudence and anticipated loss are provided for. Provided for means we have to make provision for the same. Suppose if we are expecting some debts are doubtful, we have to make a provision for doubtful debts. Anticipated losses are provided for. And when I write provided for, it means we are reflecting them in the financial. And wisdom also says that if you are expecting an income and you haven't yet received, that should not be reflected in the financial. Are you getting my point? What exactly prudence is? So, prudence simply means we have to be cautious, but we need not require to be overjoyed. You can say it that way around. So, also, anticipated losses, gains or incomes should not be recognized. Should not be recognized means should not be reflected in the financials. Welcome again. Now, second major consideration while selecting the accounting policy is substance over form. Substance over form. Substance over form. What does it mean? You have heard about it, but I have seen students sometimes actually commit mistake. Substance means reality, and form simply means legal form. For example, when I acquire an asset on hire purchase system, unless and until I would pay the final installment, I cannot become the legal owner. So technically, on form basis, form means from the viewpoint of what we call legal provisions, we can say that I am not the owner. Let us say I bought an asset and I have just paid what we call one installment and 3 installments are still due. So I cannot be owner of that particular asset. But in substance and reality, I am using that particular asset. That asset is at my disposal. I am using it. Are you getting my point? So in substance, actually, I am the what we call owner. So that is why this particular standard states that And that is also the reason, in fact, why even assets acquired on hire purchase basis are reflected in the financials as your asset. Are you getting my point or not? So even though we are not the legal owner, because of substance over form only, we recognize such assets. So that is what we mean by substance over form. Substance over form implies that entity should provide more weight to substance, that is reality. Reality is that I am using the asset, so I am the owner. Should provide more weight to substance rather than to form. So we should not give much weight, attention to the form. Form means legality, legal provisions. In legal terms, I might not be owner, but in real terms, I am the owner. So on the basis of substance, I will recognize this asset which I purchased or acquired on hire purchase system in my financials, correct? And in fact, I am giving you that example on account of substance over form, on account of substance over form, comma, assets acquired on hire purchase basis are recognized in the financials of the company, in the financial statements of the company. It means in the financials of the entity or company, whatever you may like to write. This is substance over form. This is our second consideration when we select what we call an accounting policy. Third major consideration is, of course, materiality. What we mean by materiality? Materiality means importance, significance. For example, I incurred an expense to the tune of rupees 5,000. And my turnover is 500 lakhs. 500 lakhs is my net profit, let us say. And my expense is mere 5,000. Now this 5,000 vis-a-vis 500 lakhs is almost like a drop in the ocean. So the investors or the parties whosoever are interested in our financial, this information is of least importance for them. Why the hell in the world would I care for what we call 5,000? I will care for 500 lakhs. Are you getting my point or not? So we have to assess the significance. As per this particular what we call consideration, irrelevant information should not be what we call reflected in the financials. Only material, important, significant information should be reflected. Correct? Materiality. Materiality implies that all such information all such information must not be omitted, or misstated, which could lead to misleading economic decisions. It means all relevant information must be presented. Misleading decisions. It means all significant that is material information should be presented. In financials. However, it also leads to the fact that such information which is not material, not important, which is not material, should not be considered or should not be presented. That is the point. So these are the considerations which an enterprise must consider while picking up, as I said, while selecting its accounting policies. Correct? Now we move over to other part. We know that an entity actually takes several assumptions when it prepares its financials. Correct? So we need to have a good look over that also. So we are now talking about fundamental assumptions. Correct? So fundamental assumptions, just pay attention. You have studied a lot about fundamental assumptions. This is by point number, I have forgotten. This was 9th point, I think. These are the sheets lying here. Let me have a look. Anyway, I think it was 9th point, right? Not 7th. Then, okay, 9th. Now we move over to the 10th part. Just before we move over to the next part, let me remind you one important aspect regarding accounting policies, because we were talking about the major considerations in selection of accounting policy. I have already told you, in fact I am simply writing it. Correct? Let me use the red pen. Disclosure of accounting policy. I have already told you all the major accounting policies, significant accounting policies should be disclosed at one place. Just to remind you, disclosure of accounting policies. All accounting policies should be disclosed at one place only, as far as possible. I already told you. Now there is very important line, just pay attention, which I am writing now. Disclosure is not a remedy for wrong or inappropriate accounting. What does it mean? Appropriate accounting. Just because you have disclosed the fact doesn't mean that it will right your wrong. What I mean to say here is, suppose an entity has committed a mistake and the entity simply writes by way of note that we have done so and so. So it is not a solution. You have committed a mistake. Mere disclosure will not make you get rid of that mistake. That is the point. So disclosure here means that whatever policies and assumptions you have adopted, those should be reflected by way of notes. But if we have committed some mistake and you are simply reflecting it by way of note, that will not absolve you of all the problems. Correct? That is the point. Now we move over to the fundamental accounting assumptions. I have already told you, whatever assumptions and accounting policies which we have adopted, we need to disclose that. So fundamental assumptions. As we know, as far as fundamental assumption is concerned, one is going concern. Going concern. I will use a red pen. A. Going concern. What should I tell you regarding that? Whenever we look into the financials, whenever we assess the financial of an entity, we always assume that it is a going concern entity. It means entity need not require to put up a note that it is a going concern entity and all the financials have been prepared on this basis. It is always implied of its own. Are you getting my point or not? That means whenever an entity prepares and presents its financial, it is always presumed and it is implied. Company need not require to tell to the world and that we have prepared the accounts on the basis of going concern. No. Standard says that this particular assumption is always implied. However, if you have prepared your accounts not on the basis of going concern, then you have to reflect it. It means when you are preparing your financials, that entity is not a going concern entity, then only you need to give a note. Are you getting my point? Because suppose a particular entity is expecting that by the end of this accounting year, it will close down. Then entity will prepare its financial by presuming that it is not a going concern entity. It is not a going concern entity. In that case, entity will have to give a note. However, otherwise entity need not require to give a note. So just pay attention. Going concern. It is always implied. It is always implied that financial statements FS have been drawn out on the assumption that entity is a going concern entity. So it is always implied. Entity is a going concern entity. This assumption is always implied. This assumption is always implied and therefore no disclosure is required. No disclosure is required. Because it is implied, always implied. However, if you haven't, in that case, disclosure is required. However, if in view of management, entity is not a going concern entity. Entity is not a going concern entity. Entity, then disclosure is required. Then disclosure is required. In that case, disclosure is required. Got it? Although it is not needed, but just to actually make you deft in every point, I'm going with it. Many of you are actually trying to, I know, nursing a wish that we should know that how an entity prepares its accounts when it is not a going concern. Correct? I have read your heart and mind both, so I'm going to tell you. What should I write? When entity is not a going concern entity, then in that case then in that case, entities shall prepare its financials by considering net realizable value, net realizable value of assets and liabilities, differences between carrying amount and NRV should be recorded in the statement of P&L for the period. Just to clear the air, just pay attention here. Let us say balance sheet of not so fine. Name of the company. This is the balance sheet of the company as at 1st April 2021. This is the balance sheet of the company, correct? In the balance sheet, I presume property, plant and equipment is given to you as 100 lakhs. However, its market value is just 70 lakhs. Correct? Market value is 70 lakhs. Then there are current assets, let us say worth rupees 200 lakhs, and market value is just 80 lakhs. Correct? Here we have liabilities and we have written here, let us say $200. We have written here 200. Just wait, actually. I will do one thing. This is market value 180, correct? Let us say estimated value of liability is 250. And we have here owner's equity, share capital, let us say 100 lakhs. correct? This is the balance sheet of this particular company. Now this balance sheet has been prepared. Naturally, I will always presume that this balance sheet is prepared on the basis that entity is a going concern. Let us say very next day, that is on 2nd of April 2021, management decides to close down the business. Management decide to wind up. So how I am going to draw the financials now? Same balance sheet will be presented this way. On 2nd of April, the balance sheet picture will be like this. See here, the balance sheet will be like this. I told you, when an entity is not a going concern, in that case we take what? We take the net realizable value, because market value is 70. Now I am not going to reflect it at 100. Now PPE will be reflected at 70. Similarly, current asset will be reflected at 180. Correct? And your liabilities. Your liabilities is actually 200, but now its estimated payment is 250. You have to reflect it at 250. Okay, I will do little bit of change actually, otherwise that I will not be able to make you understand. What I do, okay, I will make it 200, I will make it 100, and I will make the estimated payment at 150, just to make the point clear. So instead of 100, you are supposed to pay it 150. This is how you are going to draw out the account. Also, I have written that the differences between the carrying amount, correct, will be written in SPL. Now see the difference. The difference here is, in fact, it is a loss, 30. It is a loss. Difference here is 20, again it is a loss. And because you are making a higher payment, instead of 100 you are supposed to pay 150, again it is a loss. Total loss is actually 30 plus 20 plus 50, that is 100 lakhs. Of course, in the current year's SPL, all these losses will be recorded. All these losses will be recorded, correct? I am simply writing losses. You can also write this way. Decline in value of fixed asset, property, plant and equipment 30 lakhs, loss 30 lakhs. Decline in value of current assets, that is 20 lakhs. Increase in liability, it is also a loss, correct? Increase in liability is also a loss, 50. So you can see that ultimately there is a loss of 100 lakhs. So there is a debit balance of 100 lakh in statement of P&L. Now when I am going to write here my owner's equity is 200, and because of this loss, because profit and loss account is a part of owner's equity, because of this, now my owner's equity will be this much. So 100, 250, 250. This is how the accounts are drawn when management is of the view that entity is not a going concern. So in that case, how accounts are drawn, I have given you a sort of what we call brief overview. But the point is that in that case, disclosure is required if we come back to the what we call elements of this particular standards. Correct? So this was all about going concern. Going concern we have written. Correct? Besides that, now, as far as fundamental assumption is concerned, then there is consistency. Consistency. What does consistency implies? Consistency simply implies that whatever accounting policies which you have used in the past years, you should continue with that. Correct? And in case if you makes any change in your what we call accounting policies, you are not interested in keeping them consistent, then such facts should be what we call disclosed. So consistency implies that accounting policies adopted in the current period in the current year should be similar to accounting policies adopted in the previous year. That is the theme. That means as far as possible, there should not be any change. We should keep the accounting policies consistently same. This is the theme. But point is that, however, if there is any change, in the accounting policies, then such change should be disclosed. Obviously, such change should be disclosed. That is the point. Yes, we were about to take accrual, so sorry for a bit of delay. Now, accrual, sorry, accrual system simply implies that the expenses of a particular period should be reflected in that particular period, and expense of a particular period should be reflected in that particular period, irrespective of the actual payment or receipts. Correct? Accrual simply implies that expenses or incomes of a particular period should be reflected in the financials of that period irrespective of actual payments or receipts. You know better than I, but still, just to explain the point a bit further, say this is the current year, correct, which starts on 1/4/21, ends at 31/3/22, this financial year. In this financial year, my expenses our entity incurred expenses worth rupees 5 lakhs. However, payment was only worth rupees 1 lakh. Payment is worth rupees 1 lakh only. As you know better than I, when I am going to prepare the what we call financial, say statement of profit and loss account, I will reflect the full expense 5 lakh because 5 lakhs relates to this particular period. So financials of this particular period will be reflected this way: paid 1 lakh plus outstanding expenses 4 lakh, and entire 5 lakh will be reflected. In fact, it is because of accrual system of accounting we take into account outstanding expenses and income while preparing our financials. Is it clear to you or not? So this is the only thing which we are supposed to do as far as this particular standard is concerned, but at the same time we are going to pick up some what we call case studies on this particular question, correct, in the upcoming. After having a look over the entire provision of AS-1, now we are going to supplement the discussion with some case studies, and it is my firm belief that best way to what we call get good command, especially over the theoretical aspects of any subject, better to write as much as possible. So pull out your pens, pencils, whatever you may have, and start writing along with me. We are going to take up some case studies. As I said, case studies. Many students feel actually why I am making you write. So we have the questions, simply refer to it. You will realize the benefits once you will start writing. Case studies, correct? And I'm going to pick up first case study. Just pay attention and have a look down over here. In this case study, I write F1 Limited. F1 Limited has changed. F1 Limited has changed. F1 Limited has changed method of inventory valuation. We know there are several methods to value the inventory. So they changed the method of inventory valuation, correct? Just wait, let me actually settle the sheets. That is the only area where some attention we have to pay. Inventory valuation in the current year. In the current year. So F1 Limited has changed the method of inventory valuation in the current year from, what should I write? From FIFO to weighted average. From FIFO, first in, first out, to weighted average. To weighted average. The change, comma, however, has no material effects. Material means significant, important, no material effect. No material effect in the current year. So this change which is brought about by F1 Limited, management feels that it is not going to have any material effect in the current year. In the current year, CY, but shall have in the next year. It will not have the material effect in the current year, but it will have material effect in the next year. the management of F1 Limited thinks, so management of F1 Limited is under an impression that thinks that no disclosure is required. No disclosure is required. No disclosure is required. A comment, okay, analyze or comment. So this is the what we call case study. What is your take? Obviously you would give me the right answer. I'm very sure about that. So I write here unsuggested response or simply response. So what is the response then? Response is management's standpoint standpoint means viewpoint, standpoint is not correct, in the light of AS-1. In the light of AS-1, viewpoint is not correct. Why? The fact of change, as we know, fact of change is required to be disclosed. Fact of change, that we have changed the method, it should be reflected. Fact of change should be, or fact of change is required to be disclosed in the current year itself. In the current year itself, you need to disclose that we have changed the method. The likely effect in the financial statements, FS, financial statements, due to change should also be quantified. Should also be quantified means management should give a proper note that we have changed the method. Number one, on account of this change, so much of value has changed, so we have to quantify it, correct? And management should also present it. In the current year it is not going to affect much, but in the later years it will have an effect. The likely effect due to change should be quantified, However, if it is not possible, to exactly assess the quantification effect, then if it is not possible, then reasons should also be disclosed. Should also be disclosed. Should also be disclosed. That's the point. Correct? We take another case study. Case study 2. F2 Limited recognizes provision for tax provision for tax as per total income computed under Income Tax Act after taking into account deductions and exemptions. Comment. It seems that F2 Limited is not doing anything wrong, because generally it seems that provision for tax is created by computing income as per the income tax laws. So it seems actually that there is no mistake in it, but that is not the case. In fact, we know that provision for tax or tax expenses are recognized in the context of AS-22, because AS-22 you haven't done, so that we'll discuss later, but answer will be like this. Response. Policy of entity is not correct. As tax expenses are recognized as per AS-22, that is deferred tax asset, deferred tax liability, correct? Now, we pick up another question. Third, F3 Limited pays leave encashment. Each one of you have heard about leave encashment. So an employee can encash the leave. F3 Limited pays leave encashment to its employees, double E I have written, to its employees on retirement. The amount paid, whatever amount is paid, is treated expense in the year and charged to P&L. So what this entity does, when it pays leave encashment amount, it charges it to what we call P&L in that year itself, and charge to P&L. However, Payment of gratuity. You have again heard about this term gratuity. However, payment of gratuity to retiring partners to retiring employees is made is just let me actually settle. It takes a little bit of time actually to settle the things. Is made out to gratuity fund. Made out of gratuity fund. Which is maintained as per provisions, as per actuarial valuation, you write. As per actuarial valuation. Remember one thing, in this case study, company is making two sorts of payment. One is leave encashment, another one is what we call for gratuity. The point here is that, is the entity adopting correct accounting? Because leave encashment is being charged in the year in which amount is paid. Whereas when gratuity is paid, it is being charged to gratuity fund. So we might have had created a gratuity fund, it is given in the question, and gratuity fund is being made what we call as per actuarial valuation. So the point here is that payment with respect to leave encashment is not correct. Correct? So we write here response. As far as gratuity policy, first I am writing about gratuity. As far as gratuity policy is concerned, that is correct, without any iota of doubt. That is correct. However, leave encashment policy is not correct. Is not correct. Entity should follow accrual policy, not cash policy, accrual policy for leave encashment also. You cannot charge the entire amount in one particular year because employee has given his services to you for many years, so it is better to charge it on accrual basis. Entity should follow accrual policy for leave encashment also. Leave encashment also. Full stop. Just actually this much is enough, but just to explain the point, the leave encashment accrues to employee during tenure of service. So logically, it should be recognized over the service period, tenure of service. So entity should make a provision for leave encashment each year. Leave encashment each year. So each year of service, some charge should be made to P&L. That is the point. You cannot debit the entire amount in one go. Then we take another case study. 4. F4 Limited. F4 Limited has been providing provision for doubtful debts, provision for bad and doubtful debts. Bad and doubtful debts. Bad and doubtful debts at the rate of, let us say 10%, at the rate of 10% of gross debtors. Gross debtors. In the current year, entity decides to make provision at the rate of 5% only. Earlier 10%, now we decide to actually reduce it to 5% only. Comment. So how you are going to analyze it? Let's have a look. Response. If in the opinion of the management, if in the opinion of the management, comma, a provision at the rate of 5% is sufficient in view of prudence, comma, the entity can change the rate of provision. So, after applying prudence, if we think that this is enough, we can change, no doubt about that. However, it should be disclosed. Point is this. However, such change in estimate must be disclosed. Must be disclosed. Must be disclosed in the financial statements. Along with reasons. Financial statements along with reasons. Along with reasons. So it's simple. So if any change is brought about by the entity in the estimate, that should be disclosed, of course, along with reasons. Then there is another case study, F5 Limited has a policy of showing long-term investments at cost and current investments at lower of cost or fair value. Fair value here means actually market value. Fair value. In the current year, or in the year 2021, entity has shown long-term investments at cost less diminution, DIMI, diminution means decline in value. So in the current year, company decided to present long-term investment at cost less diminution. Comment. Don't confuse it with the fact that this question is related to AS-13. No, actually we are simply what we call facing the issue whether we need to disclose or not. That's the point is, correct? So how to go about with respect to what we call your answer, that is also very important, no doubt about that. So response, now I start writing. response, correct? Your response will be like this. In the just in accounting policy, sorry, I have written in. You write the accounting policy. The accounting policy with respect to valuation of investments should be disclosed in a statement of accounting policy, because by way of notes we have to provide that what sort of accounting policy we are adopting. So first of all, point is that we need to disclose this particular fact, no doubt about that. The policy of valuing investments is correct. However, in the current year, entity has decided to value long-term. We know that generally long-term investments are measured at cost only. However, if there happens to be a decline which in our opinion is of permanent nature, then we can reflect the long-term investment even at cost less, what we call deviation in the value. So far the value was correct, because so far the entity was valuing in a long-term investment at cost and current investment at lower of what we call cost or market value. But in the current year, however, in the current year, entity has decided to value long-term investments at cost less diminution in the value. Costless diminution in the value, correct? So, a disclosure by way of notes to accounts, comma, should be made. Should be made note should state what? Note should state that how you are going to prepare the note. The point is this: hitherto, till up to this point, it means HITHER. Hitherto, the company's policy was to show long-term investments at cost but for the current year that is 2021, these investments are being shown at cost less diminution in value. So this is how the notes shall be prepared. Correct? Welcome again. Now we are going to pick up a very formidable question. That is, which one? Sixth one. Okay, serialing is sixth one. Correct? In this question, you have to write along with me. Correct? The question is like this: 9x. This is question. I'm not writing it with red pen. 9x Limited had made a right issue Right issue is nothing but sort of fresh issue to the existing shareholders, wherein existing shareholders are given what we call rights to acquire the share. In 2020, in the offer document, to its, it's a pretty long question, to its members company had projected, company, that is 9x, company had projected, company has projected a surplus of rupees 40 crores. It means company is telling to its member that by raising the share capital, correct, we shall have a surplus of 40 crores. 40 crores. The draft the draft results for the year for the year 21-22 prepared on the basis of hitherto hitherto till up to followed accounting policies So whatever accounting policies which we have had so far followed, on the basis of that, draft results for the year 21-22 reflects policies and presented intentionally. The language of the question is pretty tough and question is pretty what we call long. Policies and presented for perusal. Perusal means for analysis. Perusal of the board of directors. Showed a deficit of rupees 10 crores. A deficit of rupees 10 crores. The board of director, in consultation with managing director, with MD, managing director decided on the following. What? 1. To value year-end inventory at work cost write in bracket rupees 50 crores instead of 50 crores instead of hitherto method instead of hitherto method of valuation of inventory at prime cost right in bracket. What is happening? Pen is creating problem. Prime cost of rupees 30 crores. So far our entity was valuing the inventory at a work cost, at prime cost, but now we decide to value it at work cost. This is what board of directors have decided in consultation with managing director. Pretty long question. Pretty long question. Point number 2. To not to provide for after sale expenses just wait, this pen is creating problem. I do not know what's the problem. I will have to switch over to some other pen. Well, there are lots of pen lying here, can't help it. So, to not to provide for after sale expenses during the warranty period. During the warranty period. Full stop. Till the last year, comma, provision at 2%, on sales used to be made under the concept of matching, cost against revenue. So, in consultation with managing director, board of director decided that we are not going to provide for after sale expenses during the warranty period. So earlier what company was doing, whatever the sales value was there, 2% of that was being actually provided for. But now they decided not to do that. Third one, to provide for permanent fall permanent fall in the value of investments. So they decided to provide for decline in value of investments. Investments, correct? That had taken place over past 5 years. So this decline had taken place over past 5 years. So now we are deciding that we have to make a provision for this. The provision being 10 crore. The provision being 10 crores. That is the provision. Provision is being 10 crores, correct? As the chief accountant, of the 9X, you are required to draft the notes on account. Pretty long question. For inclusion in annual reports. Annual reports of 21-22. Point here is this. Before we delve, let me actually reconstruct the question. Let me analyze it. It means just pay attention here. This is the sheet where we have written the question. So 9X Limited made a rights issue in 2020, correct? See here. First, let me actually give you an idea before we start writing the answer. This is the accounting year, let us say starting on 1/4/2020 and ending on 31/3/2021. Correct? So in this year, company made rights issue. A rights issue, I have already told you, is a sort of fresh issue wherein existing shareholders are offered shares. Correct? However, if they decline, then only such share can be made what we call to public, made available to the public. Rights issue. Point here is that companies want to raise some capital, and company is under an opinion that by raising this, we shall have a surplus of 40 crores. However, when we made the draft results means results which haven't yet been finalized. These are just draft result. Correct? So draft result for the next year, 1/4/2021, ending on 31/3/22. In 21-22, draft results means the results have been, the operational accounting has been actually drafted, but it is not yet finalized. That means some changes are possible. So drafted results reflects that there is a deficit, and deficit is to the extent of how much I have forgotten, deficit of 10 crore. Now there is a deficit of 10 crores. So directors decided that why we should reflect this deficit. So they want some changes. So in consultation with managing director, they decided rest of the things are given in front of you. Correct? So this is the sheet. So now we will start writing the answer. First of all, we take the first point. Question has stated that how you are going to frame the notes regarding the same. So how we are going to frame the notes regarding the same, I am writing the response now. This is response. Regarding point number 1, our note will be like this. Till the last year, comma, it was the practice of valuing inventory at prime cost. Earlier, we were valuing inventory at prime cost. At prime cost. But during current year, the same means inventory. The same has been valued. The same has been valued at work cost. Valued at work cost. Now due to this change in policy, profits have increased to 20 crores, have increased by 20 crores. Increased by 20 crores because instead of 30 crores, we are valuing it at 50 crores. And this is the closing inventory. So obviously now my profits will go up. In fact, draft results were framed. So we do not want that our financials should reflect a deficit of what we call 10 crores. So directors in consultation with the managing director made some changes. On account of that changes, definitely this deficit will get wiped out and profits will increase. But you will have to prepare the notes also. And you will tell to the stakeholders that what happened. So last year you were valuing the inventory at work prime cost. Now you have decided to change your methodology. So now you have decided to actually value it at work cost, and the value as per work cost is 50 crores. So on account of this, profits have gone up by 20 crores. Correct? That is how you will have to provide the notes. Regarding point number 2, which was with respect to what we call after sale services. Correct? It was the practice of the company to make a provision of 2% of sales for after sale expenses during the warranty period, because during the warranty period it could be a possibility that you may have to repair the damage. So you were earlier making a provision of 2%, but now you have decided to dispense up with this. However, because you have to cite the reason also, however, due to improved techniques, due to improved techniques and methods, comma, the possibility of defects shall reduce largely. So we are of the opinion that due to improved techniques and methodology, the defects will be less, and so there is no need of what we call creating a provision for the same. Correct? As such, that is how notes are prepared. The point is this: as such, company has decided to not to provide for after sales expenses, for 2% provision of sales for after sales expenses. So you have decided to not to provide. So ultimately what will happen? It would increase profits by 2% of sales, because otherwise you have had to provide what we call expense to the extent of 2% of sales. Now because you are not providing, so your profits will go up by this. Correct? So I have already told you it's a pretty long question. Correct? And in fact this question itself encompasses many questions. Third was with respect to if you remember, creating a provision for investment. Since last 5 years we haven't created a provision, but there is a decline, so we decided in the current year to provide for it, and the amount is 10 crore. As a result of as a result of permanent fall, as a result of permanent fall in value, permanent fall in value of investments comma which took place over the last 5 years, comma the company decided to make a provision of 10 crores for decline in value. For decline in value. Of course, it would decrease profit. It would decrease profits by 10 crores. Because we have to create the provision. So this is how we are going to actually give notes. Correct? Interesting question. We pick up another question. Question number 7 now. Correct? 7th, I think it was 6th, right? See in this question, a trader has purchased 500 units of certain article at the rate of rupees, let us say 10 per unit. He sold 400 articles at the rate of rupees 15 per unit. At the rate of rupees 15 per unit. Stock remaining is valued at rupees 10 per unit. At rupees 10 per unit. At what value stock should be disclosed in the financial statements. Simple question. In the financial statement. Logically, stock is valued at lower of, each one of us are very well aware of it, lower of cost or fair market value. Cost or fair value. Cost is rupees 10. And fair value here, extremely sorry, I have used the word fair value. I should use fair value, in fact net realizable value, because just earlier we did investments, so it should be net realizable value. Net realizable value. So stock is valued at cost or net realizable value. I will cut it. NRV, net realizable value. What is net realizable value? Net realizable value is nothing but sales minus sales expenses, if any. So net realizable value is your selling price, 15. Thus, remaining 100 units, because out of 500, 400 have been sold. Remaining 100 units should be valued at rupees 100 units into 10. Because cost is lower. That is rupees 1000. You might be tempted to say, but its net realizable value is 15, so what about the profit? No, it is an expected profit, so keeping prudence in mind, we are not going to take into account the expected profit, correct? This is how we have to, or we should do this particular question. Well then, in the next session, we will come up with some more what we call questions. Welcome again. After having a look over question number 7, now I think last was the 7th question or 7th case study, whatever you may like to say, question number 8 or case study 8. It's a theoretical sort of entity FXM Limited is facing a legal damage suit. Legal damage suit. FXM Limited provide for damages? Should it provide for damages? Logically speaking, it should not. We should provide only when we have anticipation that there will be an outflow of the funds. Then only, sorry, provision should be made, correct? So response will be like this. Concept of prudence. Concept of prudence should not be exercised to create hidden reserves. Because if I will make a provision, and anticipation of outflow of funds is not there, so it is a sort of reserve in disguised form, correct? So concept of prudence should not be exercised in creating hidden reserves or provisions. Provision should be created only when there is probability of outflow of funds. There is probability of outflow of funds. Then only we should create provision. So FXM Limited need not require to actually create a provision in this case. We take yet another question, and it's a theoretical question, but I will have to write a long answer to make you explain the point. If you remember, when we were writing the guidelines, we talked about this particular fact. A simple disclosure that accounting policy has been changed is not of much use for a reader of financials or financial statements. Comment: if you are going to disclose mere fact that you have changed your policy, so it is not going to give us any what we call sort of inputs where we can have a good analysis. Indirectly, it means the change should be supplemented by quantification. What will be our answer? Like this: the effect of change the effect of change should be disclosed wherever applicable. Wherever ascertainable, you write this way. That means what will be the effect? If it is possible to ascertain its effect, then it is better to disclose the same. I will make you understand. Suppose a company has changed, has switched, SWITCHED, switched over to weighted average method for ascertaining cost of inventory. From earlier practice of using FIFO. Earlier, say entity was using FIFO to find out the cost. Now it has switched over to weighted average method. If closing inventory as per FIFO is rupees 2 lakh and as per weighted average it is rupees 1,80,000. Then this change would bring down profits by 20,000, no doubt about that. Would bring down profits by 20,000. Profits by rupees 20,000. Company should disclose it this way. The company should disclose change in accounting policy as follows. Then company should disclose it this way round. The company values its inventory at lower of cost or NRV, net realizable value. Since NRV of all items of inventory in the current year was higher than respective costs comma, the company valued inventory at cost. Valued inventory at cost. Correct? Company valued inventory at cost. In the present case, company has changed accounting policy of valuing inventory at FIFO to weighted average, WA, weighted average, to reflect, we have to cite the reasons, to reflect the better consumption of inventory. We know that change in policy can be brought about to what we call give a better, proper, truer picture. So to reflect the better consumption, I will have to take the next sheet. Better consumption pattern of inventory. The change in accounting policy has reduced profits because our closing inventory will be less at 180 instead of 2 lakh, has reduced profits and value of inventory by rupees 20,000. So this way we have to present the notes. That means mere presentation of the fact is not enough. We have to supplement it with what we call reasons and their effects. That is the point is. Sorry, extremely having cough and cold. Climate in Delhi is changing. So that is the problem. Anyway, we'll pick up yet another case. In the books of Messrs Q4 Limited, Messrs Q4 closing closing inventory as on 31st of 3/21 amounts to rupees 1,63,000. On the basis of FIFO, correct? Company decides to change from FIFO to weighted average, WA, weighted average method for valuation of inventory, for you write ascertaining cost of inventory. Cost of inventory. From 2021, that means in the current year company has decided. On the basis of weighted average, method, comma, closing inventory as at 31st 3/21 amounts to rupees 1,47,000. As per this method, realizable value of inventory as at 31st 3/21 amounts to rupees 1,95,000. Discuss the disclosure requirement of change in accounting policy. Change in accounting policy. You know the answer, but still. As per the standard, as per AS-2, as per the standard, any change in accounting policy which has material impact should be disclosed in the financial statements. The amount by which change would affect financial statements should also be disclosed. That means it should be quantified. If quantification is not possible, then reasons should be cited. The reasons should be presented. There's the point. These are the disclosure requirements. The Q4 Limited should disclose what? Just wait. Important call, I can't actually skip it. Hello. Extremely sorry to make you wait. Extremely sorry. Actually, there was an urgent call, and this. So let me actually just finish it up, and then I will continue it. Correct? Okay, I will continue it in the next session because a call is urgent. Correct? Just let me see. Okay, fortunately it has stopped. So Q4 Limited should disclose the change in valuation method and its effect on financial statements. Reduction in profits. Of rupees 16,000. How this 16,000? Because, see here, just have a look over cost. Cost as per weighted average method is 1,47,000. Company has gone from what we call FIFO to weighted average, isn't it or not? And as for FIFO method, it is 1,63,000. Because we are going to value the inventory now at 1,47,000, company earlier was adopting which policy? Yes. So weighted average policy, as per weighted average policy, we see actually cost has come down, in fact, because as for FIFO it is 1,63,000 and from FIFO to weighted average. So I have written reduction in profits. In fact, it will have increase in profits. Increase in profits. Sorry. It's because of this phone call. Let me actually have a look before I write it. Weighted average cost is 1,47,000. Let me go through the question because of this phone call. I have, yes, earlier method was 1,63,000 and now weighted average is that. So my closing inventory now will be reduced. So it will definitely reduce the profit. So it is correct. Reduction in profits. Please write reduction in profit. Extremely sorry because of this call. Sometime it happens, can't help it. Because now closing inventory instead of 1,63,000 will be reflected at 1,47,000, so our profits will get reduced. Extremely sorry because of some hiccups because of the call, but we will. So welcome again. We'll pick up few more questions before we wrap this one up. It looks easy standard, isn't it? But you can see lots of questions are there and lots of variety is there. 11th, I think it is. Q5 Limited. Q5 Limited was making provision for non-moving inventories based on issues for the last 12 months. up to 31st/3/21. Company wants to provide during the year ending 31st/3/21. Company wants to provide means company wants to make a provision based on technical evaluation. Technical evaluation. Some information is given. Rupees in lakhs. Total value of inventory. Total value of inventory. Rupees 100 lakhs. Provision required based on "12 months issue". 12 months issue, rupees 3.5 lakhs. Provision, it is based on 12 months issue, correct? And provision as per technical evaluation, provision required based on technical evaluation, based on technical evaluation. Rupees 2.5 lakhs. Rupees 2.5 lakhs. Does this amount to change in accounting policy? Can the company change the method of provision? So, this is the question, correct? The decision of making provision for non-moving goods. Non-moving goods means these goods are not being utilized. Non-moving inventories on the basis of technical evaluation. On the basis of technical evaluation, does not amount to change in policy, because it's a new policy, does not amount to change in policy. Accounting policy of a company may require that provision for non-moving inventories should be made, because such inventories is lying idle, so a provision should be made. In the given case, considering the total value of the inventory comma the change in the amount of provision required is not material, because 100 lakhs worth of inventory is there and provision on based on 12 months issue is 3.5, whereas provision required on technical evaluation is 2.5. It is not material. Is not material. The disclosure can be made for such change by way of notes. So we can, what we call, simply give a note to it, and we can also mention it by way of notes clearly. That company has provided for non-moving inventories on the basis of technical evaluation. Technical evaluation instead of instead of 12 months issue. If we would have gone for 12 months issue, our provision would have been 3.5. But now we are making a provision on the technical basis, correct? Which is 2.5. That means lesser provision. So it will increase our profit. it results in higher profits of 1 lakh. Higher profits of 1 lakh. So, this was the question. We pick up last one to finish it off. Correct? It's again a clumsy case study. XYZ is engaged in the business of financial services. And its liquidity position is extremely tight, since most of the assets of the company are blocked due to various petitions. XYZ. So, lot of petitions have been filed upon this particular company. Correct? Company has accepted clumsy language, very tough language. Company has accepted intercompany deposits. It means from other companies, company has taken some deposits. Intercompany deposits. And it is making best efforts to settle the repayments. The company has provided interest as per terms of the contract. However, company has not provided for interest overdue and other payments. And other payments. On account of uncertainties, on account of uncertainties in on account of uncertainties regarding determination of the amount and in the absence of any specific legal obligation, specific legal obligation, legal obligation at present, comma, company has not provided for interest overdue and other payments as company feels these are claims against company not acknowledged as debts and has simply disclosed it by way of notes. Long question. In nutshell means there is a company whose liquidity position is very tight, and those who have given loan to this particular company, correct, are demanding back their money. Company has made the payment for interest, but there are some overdue interest and overdue payments, and company hasn't actually provided for that. So, is the treatment correct in this case? That is the what we call question. So, in the light of AS-1, what will be your take? AS-1 recognizes prudence as one of the major consideration one of the major considerations governing the selection of accounting policy. In view of uncertainties comma, company has not provided for interest overdue and other payments. Non-provision of overdue interest liability and other payment is incorrect. And company must make suitable provision. So point is that company should make the provisions. So these are the questions these sort of questions which we may actually expect from this particular standard. Just to acquaint you with all these things, so comprehensively we have covered AS-1, and obviously now it is over. So in the next session we will come out obviously with something.